of the Sinking Fund Commission to order. First order of business is the approval of the minutes. Is there a motion?
I will make a motion.
Is there a second?
I'll second.
All right, a motion has been made and properly seconded. All those in favor, just say aye, please. Aye.
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 Thank you. Approved. The next order of business is a private debt recommendation. And I'm going to turn it over to Chris for the appropriate introductions and overview.
Thanks, Don. Good morning, everybody. I'll pivot over to Floyd and Alex momentarily, but this is the, as Fran alluded to, the maiden recommendation in the private asset class, private debt for the sinking fund. This follows lengthy discussion and the sinking fund approving a asset allocation that included alternatives with a long-term target of between 5 and 7%. The folks you'll be hearing from today at Golub employ a private debt strategy. The recommended amount is around $9 million or 1.35% of the sinking fund. And with that, I will turn it over to the folks at PFM to walk through their memo in more detail.
Yes, thank you, Chris. So you all did receive the memo last week. When it comes, very high level here, when it comes to private assets, part of the risk, is illiquidity and timing, right? You're making a commitment to fund a certain allocation. It's invested over time and then returned to you over time. And, while that is the case, that those assets are sort of locked up. With that in mind, we're building out the private assets portfolio. We did want to keep an eye to liquidity. And that's part of the reason, our recommendation was to lead with private debt. In turn, as we build out these allocations, they will consist of a core, initial to a fund, and then satellite commitments to.
You're breaking up. You're breaking up. We can't hear you.
Yeah, we're having difficulty hearing you.
Can you hear me now?
We can hear you now.
Yeah, we can hear you.
Okay. So, the attraction of private debt is the relatively quicker distribution for the back end of the fund. When it comes to Golub, part of their strength is the acceleration of those distributions through their unique, evergreen holding company structure. So rather than take capital and begin to invest it at the start of the fund, Golub takes their capital commitments and commingles them with a portfolio of existing performing loans. So that does two things. That accelerates the distribution schedule, and it partially eliminates some of the blind pool risk of committing capital to a fund where you don't know what they're holding. You have a good idea of what you expect to acquire, but again, you don't get to see that. And with Golub, that is not the case. We get to know exactly what's in the portfolio on day one. So from our end, those are two fairly unique elements that add to the strengths. In the memo, again, I sort of also reference fees. The management fee that Golub charges.
So hi, I'm the court reporter. Hi, I'm the court reporter, and I can't really. It's kind of choppy, so I can't really hear a really clear audio.
And I can't either.
I'm very sorry. I guess I'll just, pass it off to Floyd. And I'll try to connect another way. Sorry about that, folks.
Hello,
Are we the
everyone.
only two that can't hear him? the recorder and myself?
I'm having a hard time too.
No, it's very difficult, Don. Yes.
Floyd,
Hi,
are you gonna, there you go.
Yeah,
Go ahead.
okay.
Floyd.
I just want to
Sorry.
make sure everybody can hear me. Everybody
Yeah.
can hear me? Okay, awesome. So with Golub, this would be Fund 14 for them. So, if I were taking a step back, looking at this and saying this is a direct lending fund, the fact that, Alex did talk about is, because its primary function is lending, and, you do have a very high liquidity within this fund, you have a chance to, number one, be able to see the type of investments that they're investing in fairly early based off of what they've done in the past. But two is the fact that, this is a fund that's been going on for a while. And, because, this is an area that has a fairly high liquidity, it's senior secured debt, the low default rates, this was one of the ways and one of the things that we really like about them when looking at this fund overall. Now, going into the fees, you'll notice the fees at the bottom, the fees that are 1% charged on the fair market value, along with, you see that, it does have a preferred return of 8%. So that means that in order for them to charge that additional performance fee of 20%, they have to meet that 8% hurdle first. Looking at the fees, you'll notice that it's actually median, below median per their peer group. So 1.3 is the usual fee. But where they actually are a little bit higher is on that performance fee. So essentially, if they do well, you'll do well. So instead of putting that within their management fee, they put it within their performance fee to align it a little bit better with what you're looking for.
So in terms of the return that we would expect, are we talking about 15%?
I wish it was 15% all the time. Because this is fixed income, we're expecting, to have, somewhere in the ballpark of a 9.54% net IRR within here. So that's what we're expecting. So about at least that 10% area, that's what we're looking at.
So when you guys make reference to the fact that it's secured, and well, let me ask the question: what's the tenor? What's the normal tenor of this term debt?
So, Alex, can you hear? Are you on now?
I can hear, yes. Can you hear me?
We can hear you.
They're about 3 to 5 years or so, typically.
And the collateral would be what?
That is, a good question. I want to say secured. It's cash flow lending. I guess that it's secured in some instances against the assets of the company. John, that's a question that I would raise to Golub today, how they view security and the placement within the capital stack. It's all senior or unitranche debt. So it's nothing that's going to be considered mezzanine, or in the event of a default, which is, I think well below 1% of the default rate, it's at the top of the capital structure.
So what I was trying to understand, will the sinking fund actually be holding the paper?
No, the sinking fund will be holding a share in a limited partnership. And the limited partnership is engaged in the making of the loans. And Golub is the general partner managing the limited partnership.
So Don, in your portfolio, what you would see a one-line asset that would be updated on an ongoing basis based off the valuation within there, where you would see that income coming in from the fund. It would actually come in through cash, but then on that income side, it would be the accounting portion would tie it back to that fund.
So I think I heard that the corporate structure is a partnership. Did I hear that?
Yes,
And the asset would be these loans.
yes.
Yes.
And the capital base would be what?
The capital base are the commitments that the sinking fund and a range of other similar investors have made to Golub Capital. So right now, I think that's roughly about 400 million or so committed to this fund, and they're targeting roughly $1 billion.
So for them to be the general partner, does that mean that in the equity they've put in more than the various entities similar to the Sinking Fund Commission?
No, typically the general partner puts in less than the investors. They do put in their own capital. Off the top of my head, I don't know what that is. But that is a question you can bring up with Golub. They are certainly putting in their own capital, but they are managing these assets with the idea of achieving that excess return that Floyd talked about, and therefore earning their performance fee. So the incentives are strongly aligned. They want these loans to do well so that their investors do well, and then they achieve, a high return.
So am I the only one that doesn't really understand how that works? Normally, again, coming from a banking background, our income was a function of the spread, cost of money versus what you're charging the client, difference being the spread. That's what you make. So you're saying in this scenario, in addition to the spread, there's something else that we're making?
Yes, and that's the illiquidity premium of dealing with these types of loans. Golub is, as a source of capital, Golub is an alternative lender. Many private equity firms go to these private lenders rather than bank lenders for ease of close, access to capital, operational expertise, and in many cases a better adjusted cost of capital than what they could get from a bank. So that's the role that these private lenders play, in the universe. And again, as an investor's standpoint, yes, Don, you're achieving, very high yields here. But again, the trade-off is, that your capital is locked up for 10 years or so.
But they will be able to explain to us how they generate those high yields, right?
Correct.
Yeah, certainly. And again, it's a lot of it is the virtue of the space in which they operate, the need for capital, and the growth in the private equity industry over the last, 15, 20 years.
Okay.
Alex or Floyd, I have a question. You mentioned the high liquidity in the fund. What is that what is the high liquidity based on? Is there a shorter lockup period? I mean, I'm not understanding why there's more liquidity in this entity than the normal private equity entity.
So that's what I was trying to explain when I got cut out, Fran. Golub basically operates an evergreen lending portfolio that, regardless of Fund 3, 4, 5, whatever, Fund 14, they're just constantly making loans out of that portfolio. And then when they raise a fund, the fund, Fund 14, for example, invests its commitments in that evergreen portfolio. So, you in Fund 14, even though it's 2021 vintage, there will be loans in there that were originated in 2018, say. And like I said, so that's why there's immediate liquidity in terms of distributions coming out of the fund. And there's also the look through into the existing portfolio. And both of those are elements that about God that we like, very much.
Okay.
Does that answer the question?
Yeah, I think so. And you mentioned that or somebody mentioned that they're at $400 million and they're targeting $1 billion for this fund. What's the sign up period? Is it?
They're at 400 right now, roughly.
When are they anticipating closing of this fund?
It's some point in 22, early 2023. The first close was earlier this spring. So they have, roughly, I think, 18 months from then, give or take. So, that's looking at the end of 2022, early 2023.
And you broke up a little bit earlier, Alex, when you were talking about the types, when you were explaining to Don the types of loans that they make. Are some of these type of loans riskier loans, people who could not otherwise get loans from a bank?
No. That is an element of why we're making this investment first, and in the size we are. These are all performing companies. They have, Golub has its own credit committee. They come up with an equivalent, rating for their debt. These are almost all entirely sponsor-backed, private equity-backed companies. So they're financing things like add-on acquisitions, capital purchases, things like that, expansion, headquarters expansions. And again, it's all senior debt or unitranche debt. So it's either it's the top of the capital structure, and it is not no special situations, no workout, nothing like that.
Okay, and I just had one other question that I think will assist me in listening to their presentation. Is in the beginning of the PFM materials, you indicate that the purpose of this is to meet the sinking fund's long-term return target and current return expectations. Can you explain to me briefly how this vehicle or similar vehicles will bolster the current equity and fixed income portfolio in meeting those expectations?
Sure. So, this goes back to the decision to add alternatives in general. Alternatives can be added to a portfolio for a number of different reasons. At the end of the day, it's all about, risk-adjusted return. And in this instance, private debt offers a, generally a more attractive risk-adjusted return than the liquid fixed income markets. And that primarily owes to the illiquid nature of these types of investments. Again, you can't just go out and, we can't go make private loans on our own. That we require the infrastructure of someone like Golub. And, that's again, why they exist. That's the role they fill. And, when you're looking at, a 9 to 10%, net IRR relative to, what our outlook is for fixed income over the next 5-7 years. This, marginally shifting some assets from the liquid to the illiquid fixed income market, we think will help achieve that target rate of return.
So as an alternative to fixed income,
Sorry?
alternative to fixed income.
Yeah, relative to fixed, certainly.
Okay.
We're swapping these, assets from the fixed income market, but, if you look at the, compare these expected returns to our expected, outlook in the public equity markets, similar and with a lower expected volatility as well.
Okay,
So
thanks.
what,
Sort of,
so what is the ultimate target? Right now, we're talking about 1.35% of total assets. In order to get the returns that you're talking about, what's the ultimate target here?
The sinking fund voted on an alternatives target of 7.5% in total. And, and as we build out that alternatives portfolio, that 7.5% roughly would be split, a third in private equity, a third in private debt, and, a third in things like real assets, real estate. And so this falls within that private debt, third of the 7.5% to alternatives.
And Alex, what is in your view, the kind of recommended pacing to get to that?
Yeah, that's a good question. We're looking at, over, I think, 3 to 5 years, is the build out. Helen, you don't, ideally you could snap your fingers and get to that target overnight, but because of the nature of these investments, you can't do that. Now, there are funds like Golub, again, because of, the evergreen portfolio, Golub will fund its commitments quicker than, some of its peer funds. But, committing to, 1 to 2 strategies per year, is sort of the pacing that, in our view, would get you to that target. And then if you kind of continue at that pace, the earlier funds will have begun to distribute in earnest, after roughly 3 to 4 years. And so, as, money is really coming back, you're continuing to commit, and you sort of, maintain that level. So, I think we were targeting looking at something in, either in real assets or private equity towards the end of this year, early 2022 would sort of be the next look.
Great, thank you.
One final question for me in terms of the performance of the portfolio. How will we, as the Sinking Fund Commission, understand how the portfolio is performing?
You will quarterly from Golub that will detail all of the investments.
Excuse me, I'm sorry, I couldn't hear your answer.
Yeah, you cut out, Alex.
Floyd, do you want to handle this?
Yes. Don, so how do you measure performance? Performance will show up within your portfolio. You'll have 2 lines. You'll have the liquid line, which will be for all of your liquid assets. So think about your public equities and public fixed income along with cash. Then you'll have a total line, which will include the alternatives. Now on the alternatives, because these come in on a lag basis, quarter to quarter won't give you a lot of good information, Don. So what you're going to want to do is look at it over more of a longer period, that 6-month time period to kind of say, okay, what really came in, 12-month time period, what came in from there, because there is going to be a lag versus the public markets based off the way that they do the striking of their NAV along with the valuation. Usually, Alex, correct me if I'm wrong, it's usually in that target area of about 90 to 120 days past quarter end. So you won't be getting that information trickling in until later. So you want to evaluate it, Don, over a longer term time period. So start really, really focusing in on it. Once you hit that 9-month period to 12-month period, then you should start seeing the type of returns within this fund going forward.
But in terms of loans performing in accordance with expectations, we won't get a sense of that.
I think just like even with public equities, you wouldn't get a sense of how would that loan performance be until you almost hit that 3-year period, at least within a manager, and it would be the same thing within here.
But so to answer your question, if you can hear me, every quarter, Golub will send out a quarterly memo that will detail new loans they've made, as well as the performance of existing loans. And you will be able to go through, they will have a list, and it'll have the name of every company, the origination date of the loan, the amount, the coupon, and really all of the details you would want to know. So you will be able to go, Don, if you are interested, and look loan by loan and see how they're performing. We at PFM also receive that information and will summarize it at our, bi-monthly meetings that we have. Now, what Floyd was trying to say is, it's just, this is a long time horizon investment. So, if you look at it, month to month, it might not be as meaningful as if you look at, performance year over year, for example. But you will have all the information that you could desire to look into any one of these companies.
So Chris, do you anticipate that information being made available on down to the level of individual loans to the board every 2 months?
I would expect, maybe not every 2, I would expect at least quarterly. And certainly annually, we would be able to get detailed holdings information. I don't think it would necessarily, at least to my knowledge, be put out every 30 to 60 days, just given the way things are valued on a lag. But for an evergreen fund like this, yes, I believe we should be able to get pretty detailed information. Let's call it every 90 to 180 days if we wanted, on how individual assets in the portfolio were performing.
What's their percent of non-performing loans in general? Do we know?
Very low, very, very low. Just pull.
All of that broke up. I couldn't hear if there was a question.
Fran asked the percent of non-performing or loans in default, their non-performing portfolio.
It sounds like it was a question about performing.
Non-performing versus, yep.
It's an extremely low component of what Golub has done historically. But all indications are that they would be very open about, any defaults. In the quarterly commentary we get, they tell us what is doing well and what is not performing as well as expected. So we have that information. We don't make commitments to private firms that are not forthcoming with all of the data. So.
Thank you.
So when they use the term sponsor-backed companies, and I'm looking at page 5, what does that mean? Sponsor-backed companies.
So that refers to what I said earlier, that they are working with private equity firms. So, that means private equity sponsors. And, in the world of private equity, there are myriad of firms out there that are going out and buying the equity of private companies. And they do that through leveraged buyouts. And in many, if not most instances these days, the leverage on those leveraged buyouts is provided by firms like Golub. They are different sides of this industry that, like I said, it really has come of age following the 2007-2008 global financial crisis, and in our view, is a long-term strategic asset class now for diversified portfolios.
Does Golub ever get a piece of the underlying company as opposed to a strictly a dollar return on the loan?
I don't want to say never, but it is not part of their strategy. They're not seeking to take equity. It may have occurred in some, again, they've made thousands of loans, so I don't want to say never, but that is not the strategy for this fund, for Fund 14. They want to be in the debt. They want to make senior loans, get their yields, and go on and make the next loan.
Right. But since it's an evergreen lending performance, those loans are not limited to Fund 14, right? They could be leftover loans from previous funds. Is that how that works, or am I misunderstanding that?
Yes, you're correct. I wouldn't say they're tagged to any fund. They're all part of the same strategy, though.
Okay.
I'm going to have mezzanine in this. Golub does do other types of lending. They have other holding companies set up for those other types of loans.
Gotcha.
This is pure within the guidelines of the strategy we're seeking.
Thank you.
And Alex or Floyd, are there any concerns around leverage in the loans? I think it's 2 to 2.5%, or 2 to 2.5.
Yeah, so that is leverage that is placed at the fund level. So again, Fund 14 is taking investor commitments, and then that capital base is enhanced through the use of leverage. That is how they get from maybe a coupon of roughly 6% to a total return, approaching 10% and beyond. In our view, the use of leverage is beneficial in this asset class. It was a discussion that PFM and Chris had, numerous times leading up to this point. Do we go with a levered or unlevered option? And again, it was PFM's recommendation, and it remains our view that the use of leverage, it's sort of an inherent or beneficial element to this asset class. It's something that you can do to enhance the risk-adjusted return, it's not something we would recommend for a traditional fixed income portfolio, but the closed-end nature, the experience of the general partner in Golub, and their extremely low default rate gives us the confidence and the desire to use leverage. We don't agree necessarily. Private equity is already levered up. Excess leverage in real estate, we don't necessarily agree with. Same thing perhaps for a mezzanine lending fund. But again, the space where Golub operates and their experience, and also they're able to access the leverage market. You'll hear from them, in a very cost-effective manner. They're not paying up for leverage, so that further enhances the return they can deliver. So it's something that we recommended for this allocation.
Great, thank you.
Is there any oversight coming from external sources on the portfolio, or is the only oversight internal?
No, there are external, is an external administrator, and auditor, that, values the portfolio, from a standpoint. So, again, Golub will report the value of their loans, and they might say, we're going to hold this X, at X valuation. If the external auditor disagrees for whatever reason, maybe Golub is too aggressive with their projection, that's where the external auditor comes in and will say, that's not a realistic price, or it's faulted, you're not getting it back. So yes, Don, it's not just Golub valuing these loans. And then at the end of the day, of course, by the time the fund has run its course, your capital will have all been distributed back. So it's real cash on cash yields that are given back to you, the investor, by the time it all winds down.
No more questions from me.
None for me either.
Don, Fran, Nick, would you like us to bring them in?
Yes.
Okay. Billy, if you could let them in, that would be great.
Sure, Chris. And when I bring them in, you want to give them the speech and then just let
Yeah.
them know.
Yep.
Thanks. You're good to go, Chris.
Good morning, everyone. Golub, thank you for joining us this morning. You'll have roughly 20, perhaps 25 minutes to make your presentation to the board. Your primary audience will be members of the commission. You have Don Scott, who's our chairperson, Fran Bielli, who represents the finance director, and Nick Hand, who represents the city controller. And then you've also got various representatives from PGW, staff, PFM, and others in the audience. Bill, who's handling the technical aspects, will try to give you a 5-minute warning or so if you're running low on time. And with that, when you're ready to begin, we look forward to your comments. Thank you.
Thanks, Chris. This is Ross Vanderlinden speaking, and appreciate the team from PFM for recommending Golub Capital, and thanks to everybody for joining this morning. I'm joined by my colleagues, Gregory Robbins, who's a senior managing director on our investor partners group, and Tim Kleiman, who's a managing director and head of our ESG. I'm Ross Vanderlinden. I joined Golub Capital 8 years ago, and I'm part of the investor partners group working with PFM and their clients. I joined Golub Capital, as I mentioned, 8 years ago after about 15 years in investment banking. Started my career at the old First Union Wachovia. Had known David and Lawrence Golub, the principals of Golub Capital, now for over 15 years. This morning, I'm going to have Gregory introduce Golub Capital, talk a little bit about what sets us apart, where we play within the middle market direct lending landscape. Then we'll have Tim Kleiman talk about our team and some of our initiatives in building out our team over the last 15 years. And then I'm going to conclude the presentation talking about Golub Capital Partners 14, our flagship vehicle that we're in the market with now. If there are any questions, we're happy to take them at any time, but otherwise I'll turn it over to Gregory to kick off the presentation. Thanks, everybody.
Great. Good morning, everyone. I'm going to start on page 5 here. And as Ross mentioned, I'm going to provide a brief overview of Golub Capital, and then talk about why we believe sponsor finance lending is interesting, and then why sponsors choose Golub Capital as a financing partner of choice. So here on page 5, you can see that Golub Capital is an alternative asset manager specializing in direct lending. Our firm was founded 27 years ago in 1994, and we have a long and successful history of lending to U.S. middle market companies through different macroeconomic environments. Today, we manage over $40 billion of capital with more than 550 employees and 140 investment professionals. Our core business is direct lending to US-based companies backed by private equity sponsors. And we define direct lending as lending to middle market companies that generate between about 10 million to 100 million of EBITDA. We focus on the top part of the capital structure. In fact, virtually everything we do is first lien, first out, senior secured debt. We target resilient companies in non-cyclical industries with particular expertise in software, healthcare, specialty consumer, and financial services. If you could move on to page 6, please. This page highlights our capital base, which is large and diverse. Our largest pool of capital, which represents over $30 billion of capital, consists of our flagship GCP funds. Today, we're in market with GCP 14, and Ross is going to speak in a few minutes about some of its unique benefits that we'll go through. If you can move on to page 7, please. Here we highlight our long-standing track record of low default rates. As you can see here on the left side of the chart, over the last 17 years, our average annual default rates have been less than 1%, compared to the broader market at a bit over or around 2.25%, about 2.3%. But we've always believed that the true testament to a credit manager's performance is reflected in not how they perform when things are going well, but rather how they perform during dislocations, downturns, and recessions. And you can see, for example, here on the right side of the page, in 2009, our peak default rate of a little over 3%, compared to the broader market at 9.6%. Interestingly, during COVID in 2020, and this is the middle part of the page here, our default rate was essentially in line with our historical averages at roughly 1%, compared to the broader market at about 4%. And in fact, and you'll see this once we've shared updated numbers through June 30th, our updated COVID default rate is 80 basis points, so lower than our 17-year historical average. So we've navigated the COVID period very successfully.
Hi, Greg.
Mm-hmm.
I wanted to interject a question before we moved off of this page. This is Fran Bielli. The 2008, where your peak default rate was 3.06%. Could you tell me what the IRR was for that particular year? Can you narrow it down for that year?
Sure. It was actually 2009. It may be a little hard to see. Sorry if
That's
the
okay.
is small. So in 2009, our funds performed very well. We've only had 2 quarters going back to 2004. So this is, I think, over 60 quarters, and Ross will share the data with you, where we've had negative returns in our funds. And that's Q4 of 08 and Q1 of 2020. In both quarters, 08 and 2020, the negative results that we had in our funds were driven mostly by unrealized write-downs that we experienced. And then in subsequent periods, those write-downs reversed themselves. They did not crystallize into realized losses. So 2009 was actually a very strong year for our funds, as was the second half of 2020 and into 2021. So we've seen a complete rebound as those unrealized write-downs have reversed.
Okay, so no real correlation between the 3.06 default rate and the return for that given year.
Correct.
Okay,
Correct.
thank you.
And Gregory, just to come in here, so we our funds in 2009, Fran, we were up about 20% in 2009, and what you'll find with our funds is that we'll talk a little more about this in the structure, is that our funds really are a function of both realized and unrealized gains and losses. And we had, as Gregory mentioned, we had unrealized losses in 2008. We had a few realized losses in 2009, but actually the unrealized gains in 2009 really drove the returns in 2009, combined with when you have periods of time when defaults increase, you see spreads increase. And that spread increase that you saw in 2009 actually made up for all the losses that happened in 2009 as well. So we're sort of in a period of time like that now, where we had losses in early 2020 unrealized. We're now going through a period of time of gains as we reverse those mark-to-markets, and spreads have widened.
Okay, no, that's perfect. Thanks for the answer.
Chart of it.
So there's a difference between default and charge-offs. Am I correct?
Correct. So default rates don't necessarily mean losses. Loss is calculated as default times your recovery rate. So ultimately, you want to, when there is a default, you want to maximize your recovery rates. And what we've experienced over the last 18 years is, while default rates are very low, we still have very meaningful recovery rates given where we play in the capital structure. We're typically getting 60 to 70 cents back of the principal that is defaulted. And that does not include, by the way, interest and fees that we've earned along the way. So it's a very resilient asset class. We've shared with PFM our long-term track record, and it shows really over the last 17 years a level of consistency. That's what we're known for. We're known for being boring, consistent. We pride ourselves on that. That's what our investors really entrust their capital with us to shepherd through good times and bad times.
So do you want to talk a little bit about your charge-off experience?
Sure. I don't know if that's in this FOIA presentation.
It's not in the presentation. And Gregory, I can maybe just briefly chat on 2020. So in 2020, you mentioned our default rate was in line with our long-term default rate of about 1%. That was 4 instances of default in 2020. The recoveries for those loans, 3 of the 4 recoveries were actually above our historical average. So, and again, I'm not looking at the exact data, but I believe we had 1 in the 90s, 2 in the 70s, and then 1 below our average. So actually the loss rate in 2020 was actually quite low. And again, if you're looking at the long-term default rate of just around 1%, the recovery rate over that period of time averages between, as Gregory said, between 60 and 70 cents on the dollar. So a loss rate of between 30 and 40 basis points per year.
Thank you.
Great. Let me shift quickly, and if you wouldn't mind jumping ahead to page 28, and then I'm going to go back. Sorry about that. Because I want to talk about the market opportunity, and I think that's best summarized just on this page. So four key points I want to make. First is, and this is on the top left, the opportunity set for us, the U.S. middle market, is large. You can see the sheer size of the U.S. middle market. As a standalone economy, it's something like the 3rd or 5th largest economy in the world. Second key point, and this is the chart on the upper right, the banks have all but exited this market. It started when I started my career in '97, and it's only continued. And that void has been filled by non-bank finance companies like Golub Capital and others. Third key point, and this is on the bottom left, the shift from the public markets to the private markets is undeniable. Here we show the amount of private equity capital that has been raised and not yet spent. And you can see the numbers are a little small, but at the end of March 31st, 2021, there was over $1.6 trillion of raised and unspent private equity capital. Now, not all of that's going to be in the US, not all of it's going to be in the middle market, but a good chunk of it will be. And we think that's going to continue to drive robust deal activity in the coming periods. And then finally, the chart on the right shows really the strength and health of the middle market. We publish every quarter what's called the Golub Capital Allman Index. And you can see here, compared to other indices, it's continued to perform very, very well. So for all these reasons, we continue to believe that this segment of the market is growing, it's attractive, and we're well positioned to continue to capture our fair share of good opportunities.
I have one question on that. As if the capital for private equity has increased so much and it's unspent, why the need for lending?
Sure. Most sponsors, when they buy a company, not all, but most, seek to enhance their returns by using some form of leverage.
Gotcha.
So typically where we're brought into a transaction, it's in connection with it's called a leverage buyout. Sponsors buying a company for 15 times earnings, and they want to finance part of the purchase price with debt, similar to how people buy real estate. They buy a home, an apartment, they go to a bank. The metaphor is very similar, except we're not lending to a house or an apartment, we're lending to a company. And so that drives the financing need.
Right. You got it. Thanks. It's the
You know,
use of the use of other people's money in order to gain. I get it. Yeah, I get it.
Right.
So one of my questions is, I noted that all of your deals are collateralized deals.
Yes.
I was just wondering, for these types of transactions, what type of collateral are we talking about?
Sure. So we're, as I mentioned, we're top of the capital structure. So typically there's no debt ahead of us. Oftentimes there's no debt behind us. And we have a lien, what's called a first priority perfected lien, on all of the collateral, all the assets of the company, including a pledge of the stock. Now, our loans are what are called cash flow or enterprise value loans. So we're lending against the going concern value of the business. If the company were to get into trouble and had to liquidate, we would get some recovery, but we're not an asset-based lender. That's still what banks heavily do. So liquidation of the collateral, selling of property, plant, and equipment, receivables, is unlikely to get us a full recovery. That's not what our underwriting is based off of. Our underwriting is based off of, is this a good company? If it were to get into trouble, is there a strategic buyer that would want to own that company for value in excess of our debt? And that's what we're really experienced in understanding and analyzing, is what we call a second way out. If the business gets hurt by a recession or unforeseen issues, is there still a business there that someone's going to want to own? And that's what we focus on. And that's what we have the last 25 plus years of experience doing.
How often do you ever, I should ask it this way, do you ever receive equity in lieu of capital in any of your deals?
So oftentimes in connection with our debt, we will make a small equity co-investment alongside the private equity firm. And that equity co-investment also resides in our funds. So we allocate the equity with the debt. And it's upside potential if things go well, which they usually do. And we have a terrific track record. The only other time we would typically get equity, and it's atypical, is if there was some sort of restructuring. And sometimes maybe our debt might be converted into equity. But again, that's very, very rare given the types of companies we finance and where we participate in the capital structure.
Okay, thanks.
Sure. So let me go back, to now page 11, if you wouldn't mind. Sorry for the back and forth, and we'll be more consistent going forward. So really just want to shift now to speaking to why do sponsors work with us? They have a lot of choices. And why work with Golub Capital? And one of the key reasons is that we need to be able to offer compelling, reliable, and distinctive solutions. And we do that through the power and size of our sponsor finance platform. So here on page 11, what you can see here, and we source our deals directly from private equity firms, is we have relationships with over 300 different private equity sponsors. We've closed at least one deal with over 300. We've closed multiple deals with over 200 of them. In fact, and this is the chart on the right, over the past 8 years, over 80% of our lending is with sponsors we worked with previously. So there's a sense of repeat business in our business that is very powerful. We know them, they know us. These relationships are designed for mutual success. Another example of this, and if you go to page 13, please, is what we call repeat business from our existing portfolio companies. So here we highlight, and this is the chart on the left, that over the last 8 years, more than 55% of our lending has been with borrowers that we've previously completed at least one transaction with. So we call these incumbencies. Generally speaking, our portfolio companies are growing, they're acquisitive, and we're in the pole position to lead the next add-on financing. Think about it. Sponsors, companies work with you, they want some incremental capital, much easier to work with the existing relationship lender than bring in a whole new set of lending relationships. And from our perspective, and this inures to the benefit of our investors, we know these companies inside and out. We did the initial due diligence, so we spent 3 to 5 months underwriting these companies. We've developed a relationship with the management team. We've seen firsthand how these companies operate and perform. So this is a key driver of how we're able to maintain very low credit losses over time. Last point I want to make before I hand it over to Tim is on page 15, please. Another key benefit is the origination engine of our platform. So what we show here is in a typical year, we're looking at over 2,000 opportunities each year, and we're closing between 2 to 3% of them. So we have this wide funnel of opportunities, and we quickly figure out which ones do we want to spend time on and which ones do we immediately want to kill. And this allows us to be selective and disciplined. So wide funnel, we focus on deals that we really like. We put a lot of resources, we spend a lot of time on it. We go through various processes internally to make sure we've done our underwriting very well. And if we can do that, coupled with all the other key elements that we have in our platform, it's kind of a self-fulfilling cycle that generates consistent returns for our investors. We focus on rigorous underwriting, risk management, alignment of interest. We're big investors in our funds alongside all of our other investors. Our people are compensated on a long-term basis, not on short-term credit results or short-term deal volume. And maybe most importantly, our deep and experienced team. And for that, let me turn it over to Tim, unless there are some other questions for me to talk about our team and some of our other initiatives there.
Thanks, Gregory. And hello, everyone. Thanks for taking the time to speak this morning. I know we're a little short on time, so I'll run quickly through my piece. And if you wouldn't mind pulling up slide 10, I think that'll be a good reference point for us. So in terms of our team, oh wait, maybe it's the page right before that. I think. Where's the ESG slide?
I think it's
8. Sorry,
yeah,
I must have it. Keep
going back. Sorry.
I must have pulled up the wrong version of the presentation. It might be a bit earlier in the presentation, but in any case, this is a slide on ESG, which hopefully you'll have.
It's page 8. If we could pull up page 8.
Okay, perfect. So I've been with Golub Capital for over 10 years. I stepped into this role of head of ESG, earlier this year, and that was primarily because I've seen the firm's commitment to ESG and commitment to diversity and inclusion throughout the course of my career here. It's something that's become, sort of more of a focus recently of investors, and I think rightly so. But we've long been believers that, being attentive to ESG factors in our investment process helps us make better credit decisions, and being attentive to diversity, equity, and inclusion in our internal practices like recruitment and retention and training makes our business better as well. So there's kind of a nice alignment between what's good for our business and what's good for society as a whole. I understand that the Commission is very interested in diversity, equity, and inclusion, so I'm going to focus my my remarks on the right-hand side of this page. One of the areas that we focus on is on training and development. So we try to have a best-in-class, highly curated training and development program that gives very specific resources and guidance to employees on how to complete and advance their career journey at Golub Capital. we found is that this helps kind of level the playing field to some extent between talent who come in from different backgrounds, because we're able to provide a consistent set of resources that meets people where they are and elevates them to be successful in their careers. A second key component of how we approach our diversity, equity, inclusion efforts is being mindful about how our corporate philanthropy operates. We focused very carefully on supporting initiatives that directly address racism, that directly address educational opportunity. We sponsored a series of social impact labs, Golub Capital Social Impact Labs at leading business schools to help increase the effectiveness of the nonprofit sector outside of the ones that we directly fund. So it's been really important to us to have our philanthropy match the value that we ascribe to having a diverse and inclusive culture. Third bullet point here is that we focus a lot on data. Data is very much kind of the core of what we do overall, and I believe we completed the template that you requested. Just level setting on data, about 50% of the firm as a whole is identifies as female or a person of color. That's about 40% of investment professionals, and about taking into account mid-year promotions and hires year to date, it's about 30% among senior leaders of the firm. There's always opportunity to do better, and that's one of the key focus areas that I have as head of ESG is continuing to make sure that we not only raise the bar for our existing employees, but also expand our access to pools of talent that may not have otherwise considered a career with us, and helping grow that talent. The data gets reviewed all the way up to the CEO and the president of the company. We recently went through our round of mid-year promotions, and one of the analyses that the leaders of the firm looked at was just is the proportion of promotions being granted proportionate to the employee demographics as a whole, to make sure that we're appropriately advancing people of all backgrounds. Fourth point here is just we've built out a series of internal resource groups. So basically to help employees network, learn, identify peers that they can connect with. I co-chair the Pride Plus BRG. We have a group for women, for next gen employees. We're launching a BRG for people of color at the probably before the end of the year. So we think that these are grassroots efforts that really help create a tangible sense of inclusivity in the culture. And then finally, we became a signatory to the Institutional Limited Partners Association Diversity in Action Initiative earlier this year, and we wanted both to sort of publicly signal our commitment to diversity and inclusion, but also to have the opportunity to learn from our peers and learn from industry best practices, because we always think there's an opportunity to do better. With that, I will hand that back over to Ross.
Thanks, Tim. Really appreciate that. I'm going to conclude the presentation today, and I'm going to, if we could turn to page 22 to talk briefly about Golub Capital Partners 14. As I mentioned earlier, Golub Capital Partners 14 is our flagship vehicle. The first close was on April 1st. We've raised about $400 million of investor capital to date. And we find that investors are drawn to Golub Capital Partners 14, not only for the reasons that Tim and Gregory alluded to, our industry best research and underwriting capabilities, our connectivity with our private equity sponsors, which allows for a wide sourcing funnel, but also because of the efficiency of the Golub Capital Partners 14 fund and its program. As an investor in Golub Capital Partners 14, you're going to have a vehicle that really solves for what we consider to be some of the shortcomings of traditional private funds. When you're investing in Golub Capital Partners 14, you don't have a vintage effect like you would in a traditional fund. You're immediately buying into an existing portfolio of over 500 borrowers, which allows for a much more efficient ramp up process, but also much more efficient ramp down process. If you'll turn to the next page, page 23, this is a depiction of our fund ramp where you're coming into an existing portfolio, and immediately as an investor in Fund 14, you start accessing the GCP portfolio and earning interest on that portfolio. So you would expect that the current portfolio today is generating a a run rate distribution of 10, 11, 12% per year, or on an annualized or on a quarterly basis between 2 and 3% per quarter. So would expect that as an investor in GCP 14 that you'll start to get that distribution right away. And that'll continue for the next 7, 8, 9 years as you're invested in the GCP portfolio. If you go to the next page, page 24, you'll see that the portfolio you're buying into, GCP, is a very diversified portfolio with over 500 different borrowers, very diversified in terms of obligor, in terms of industry, in terms of geography, in terms of vintage, in terms of private equity sponsor. So unlike a traditional private fund, which is relatively concentrated at the beginning of the fund's life and relatively concentrated at the end of the fund's life, our fund is very diversified immediately, so it feels much more like a fixed income product. Those are really the salient features of the GCP fund and Golub Capital. Really appreciate everyone from the board to allow us to speak this morning. Know we've run a little bit over, so maybe I'll pause just for a moment to see if there are other questions on the Golub Capital Partners 14 structure or Golub in general. Chris and the team from PFM, thanks so much for allowing us hearing the questions. Again, we're happy to be available for any follow-up questions after this, but we know that you've got a busy agenda this morning, so we can sign off if that's necessary.
Sure. Hearing no questions from Don or Fran or Nick, yeah, thanks to your team for your time this morning, and you know, a member of PFM or myself will be in touch if there's any additional follow-up coming out of the discussion. Thank you very much.
Thank you, everyone.
Yeah, thank you.
Yeah, thank you.
Bye all.
Chris, you're clear.
Thanks,
So let
Bill.
me-
So open
Let
it
me
up
pose
to
a question. Let me pose
questions.
a question
Yep.
to Christopher. Christopher, can you hear me?
I can, Don.
Earlier, you indicated that you and PFM evaluated a number of other providers, but chose this particular firm as the one we should look at first. And could you again share with us the factors that you saw with this firm that convinced you that this was the one we should go with?
Sure. Go ahead, Alex.
Yeah, we at PFM probably had a list of 20 firms that we looked at realistically that we keep tabs on just anyway. From that list, we brought 5 to the table that we wanted to look at in earnest alongside Chris. Golub stands out for a number of reasons. I think, one of them is certainly their track record. They've been doing this for 14 funds with a low default rate, a high recovery rate, strong returns, and they're doing, basically exactly what we're looking for. Their management fee is below average. Their performance fee is average, and we're okay with that. We'd rather, I think, see a lower management fee that gets charged regardless of performance. And, again, the guaranteed fees are lower and the performance fees are average. That's a structure that we like better than, say the other way around. And then Golub has an experienced and deep team. You saw the number of investment professionals, and because at the end of the day, making loans, this, Don, you've got to have the infrastructure in place to review all of the deals, maintain relationships with these borrowers, and they do that very well. It's funny when we were speaking with some of the other firms, other firms will sometimes, in a way to distinguish, themselves, they might say, oh, we're not using them as an example. In our view, I think that's indicative of the success that Golub has had and the leadership position they've got in this industry. Some of the other firms we looked at that maybe had lower fees, for example, they didn't have the team, they didn't have the track record. Two of the firms we looked at were, raising their second funds. And so, that ultimately, despite some things we liked about them, we didn't, have the confidence to make a long-term commitment with a firm like that. Some of the other firms we looked at, there were some organizational issues. And ultimately, Golub was exactly what we were looking for, in a package that, it has been successful and is, frankly, cost effective, average or below. So, that's what we liked in them.
Have you guys, have you all had other clients utilize this firm?
Yes, we have recommended Golub to several non-discretionary clients. And we also have, I don't know, Floyd, you may know the exact amount or ballpark figure, but in our non-discretionary OCIO consulting or OCIO client base, we utilize Golub for a number of pension clients funds, where it makes sense, where we have the size and scales.
Hey, Don, because Alex is going out, just pure numbers, I would say we've utilized it within at least close to about 15 discretionary clients that their dollar amount ranges in AUM. You have some that are north of 600 million to those that are just around 25 million. Within the discretionary portion, we utilize them as a core manager because we look at them and say, they're a manager that provides a good risk rate of return along with safety of capital.
And to add to that, this was an independent process. We have no relationship with Golub. We went into this process with no preconceptions that they would be selected. We actually were using this process to validate our own decision to use Golub with other clients, and even going in with an open mind, it in our view, it validated the fact that we like Golub. They are our recommended manager in this segment of direct lending. Senior secured middle market. Golub, in our view, is the leading fund family.
So did you perform due diligence on the other firms that were on your list, or just because you recommend Golub across the board, recommend them to us?
No, I would say we did a full, diligence, review. Like I said, it was an opportunity to start, from scratch. Again, we sort of removed all prejudice and went in completely open minds. The funds fell where they did. There were other strategies that were attractive. Ultimately, frankly, I think the second place fund operates in a space slightly below the middle market, which just invites some additional risk in making these loans. And we felt that the higher size loans that Golub was making, slightly larger companies, splitting hairs to some extent. do favor the space range where Golub operates. And so that was ultimately sort of you're looking at a lot of different factors, but at the end, we were pretty confident in this decision, and it was a full review of all the 5 funds in question.
So let me ask Christopher another question. Christopher, I think we've discussed the fact that the city of Philadelphia is also not looking, but does have these types of firms in their portfolio. It may be more real estate focused versus this type, but I'm not asking you to name names, but do you have anything in the city portfolio that would compete with this structure?
We do. And a couple of the competitors, including the recent ones, were on the short list here. I would suspect that at least one of those competitor funds that was or that is in the Muni Fund is likely to be on the short list or a finalist when we come back with another private debt allocation, next year or the year after. As Alex said, there's a few folks that we think pretty highly of in this space, Golub being one of them. And, nothing about Golub, either that they do or don't do, concerns me relative to other folks we may have done business with in the Muni Fund. I think there's 3 or 4 firms that we think, maybe a couple more, but 3 or 4 at least that we think very highly of, and this is one of them.
Thank you. And I'm gonna ask this question again, and it may be because I'm thick, and sometimes early in the morning I'm extremely thick. So remember, I said normally your income is a function of the difference between your cost of funds and what you're charging the client. And that's what we refer to as spread. In this case, it seems like there's other revenue sources other than just the interest income. What are those other revenue sources?
Yes, and that, good point. I do apologize, actually. This goes to something else. Fran, I know you asked about equity stakes. I did misspeak originally. They do take very small equity co-investments in some of their funds, some of their lending companies. Also, another source of revenue that they mentioned are fees. Don, you probably remember that. Just like a bank will get a fee when they close, a syndicated loan, Golub is taking fees when they make these loans. That's another reason why might a firm go with Golub. Maybe their fees are a little bit lower, speed of close, etc. And I don't want to dismiss that. That's not a meaningless source of return, but it is, it's more nominal. They might be taking, a hard dollar fee of $600,000 or so, per loan or something like that. So they are getting fees, much like a bank would for a closed deal. But really, we're paying their fee to them to make loans, generate good loan terms is, really what we're seeking from Golub. They're also taking small equity pieces. Again, in successful companies, they're not operating these companies. They'll participate in that upside, and then they'll get closed deal fees as well.
I'm still having difficulty hearing you, but I think you said, in addition to the spread, the cost of funds versus the price that they're charging the client, they also get fees I got that. Is there a third revenue source, or are those the only two?
Equity.
There's the equity upside of they're taking small ownership of 1%, 2, 3% equity in these companies. Not all of them, some of them. And you know, when the private equity firm exits, Golub will also make, you know, a return on that equity.
Got it. Okay, thank you.
And I don't know if anyone can explain this to me, the unrealized write-downs versus the realized write-downs. They talked about that in, I guess, Q1 of 2008 or 9, and then another quarter in 2020. What accounts for unrealized write-downs? Is that a mistake in timing of writing it down, or are they allowed to spread out write-downs in order to kind of smooth out their returns? How does that work?
You know, I'm not.
Alex, I can take that.
Go ahead, Floyd.
So Frank, it goes on the timing of the impaired asset. So how long is it going to be impaired for? If it's going to be temporarily impaired, then at that point in time, you know, they'll say, okay, well, we know that right now, you know, this isn't worth 80 cents on the dollar, it's now worth 70 cents on the dollar. So, you know, that in that time frame, they'll write it down based off of current business economic environment. So let's say, you know, that, like, for instance, if there might be a cash flow hardship for the next 6 to 12 to 18 months, they'll have to write that down. Now, if it improves, then they can write it back up based on those revenues and what the auditor sees as, okay, this business has fully recovered. If it hasn't fully recovered and they have to make it permanently impaired, then that means that won't be written down, and they'll have to actually take a realized loss on that within their income.
Yeah, thanks, Floyd. So who determines the timing of that is really my question.
So the timing is, you know, it's a little bit with the auditor and a little bit on them, but they have to go out there and actually prove that this business has the cash flow behind it in order to justify that, because their auditor is going back behind them to check those numbers and ensure that those valuations are correct.
Okay.
And, you know, my understanding is that, you know, the write-downs are taken, you know, in the quarter when the valuation is completed. So, you know, that's why there can be some lumpy returns in, you know, in all private investments, you know, especially, you know, think of a fund that might only have 10 loans in it at a time. And, you know, they take a write-down. You know, that write-down will be taken in that quarter. To the best of my knowledge, it's not spread out over any time. But, you know, 10 investments and one is written down, you'll have some lumpy returns. Whereas, you know, one of the benefits of Golub, there's already this large portfolio. Even if there are some write-downs, it should just generally have a smoother experience by virtue of the diversification.
You know, in the banking industry, the banks set up reserves, and the charge-offs go against the reserves. Now, I asked a question about charge-offs, and I don't really think I got an answer on that. But these guys may do it differently. And when you use the term write-downs, I think that really is they are charging to a reserve for the event. If there is a charge, they write it off against that reserve. Is that possible?
That may be the case. I do know that Golub reserves about 10% of fund commitments for special situations. I don't, you know, not special situations lending, but for, you know, the needs like that. So that may well be what they're doing in those situations. I don't know certain though.
On the diversity side, they did make reference to people of color. And Chris, if you could just make sure that I think I know what that definition is, but I'd like to know what their definition is.
Sure, Don. The definition that we provide, the template that we provide, follows the mayor's executive order and the federal guidelines or rules. So they break it down into female and male, you know, obviously in terms of the gender, that's the way the classifications are. And then for persons of color, it'd be African Americans, Native Americans, Asian Americans, Hispanics, folks who identify as multiple races or ethnicities within that, within those categories. And then there may be another category of other, you know, for folks not properly captured by those four. So we're tracking the mayor's rules or guidelines on that, as well as the federal rules as we understand them.
So, and that's where I was going. In the chart that you gave us, it used the term minority. In his presentation, he used the term people of color. And are you saying it's one and the same?
Yes, the way the chart is written does refer to persons of color. I can speak with Adam. I don't think there's an issue with if we change that on the chart, if that's the preference moving forward. But no, those two terms for purposes of this presentation were the same.
Yeah, and the other thing I would just ask is, and again, maybe we don't have the ability to ask this question, but in terms of breaking it down, Asian, African American, Native American, I mean, can we get that information in terms of what comprises these different minority categories?
We can certainly ask. I would say most firms are, a lot of firms are becoming increasingly willing to do that. Some are still a little bit hesitant. There's obviously nothing to stop us from asking that I'm aware of. I'll defer to Adam if I'm mistaken about that. And we're certainly happy, PFM's certainly happy to make that granular of a request, you know, to this manager and to, you know, any managers going forward.
Thank you.
Bill, the chart I see right there is the total firm level diversity. Can you show me the total partner or investment manager level diversity?
It's up top.
So it's 27% versus 50%, right? Okay, thank you.
Bill, is there three or there two?
Yeah, there's three.
Three, yeah.
It's
okay.
Partner, investment professional, and then total. Yeah.
Yeah. No, I just wanted to make sure I had provided the right chart. Thanks, Billy. Thanks, Fran.
Yep. Well, what's the pleasure of the commissioners? You want to vote on this, or what's your pleasure?
Don, it seems like you still have some outstanding questions. I'm certainly amenable to waiting for your questions to be answered if you'd like to go that route.
I really would, but I would also be receptive to having a special meeting so we could go in and make a decision pretty quickly.
I have no problem doing that. I'll make myself available. There's only a couple days that I'm unavailable, but yeah.
That works for me as well. Yeah.
That work for you, Chris?
Yeah, and Floyd or Alex can correct me if I'm wrong, but because this is a you know, an evergreen fund, I don't think there's anything that would, you know, prevent the vote from taking place in September. Don, obviously we can make the request for the granular breakdown at, you know, on the ethnicity and race, etc. If there's other outstanding questions from either you, the controller's office, or Fran, if you could get those over to PFM and I, you know, sometime this week, If you either want to call to discuss it or send them an email, then I will get those all to the manager simultaneously and be able to provide a response when we have everything back.
Yeah, my other question was charge-offs.
I didn't hear you. I'm sorry. Charge offs?
Yes,
Okay.
I don't think he answered that question. So I just want to know what are the actual over the last, let's say, 3 or 4 years.
Okay. Yep.
So I guess, Chris, I'll make the motion to table this for a special meeting pending the answering of the outstanding questions.
Is there a second?
I will
I
second
second.
that. At least, there we go.
All right, so a motion has been made and properly seconded. All those in favor?
Aye.
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 All right, we have a plan.
Thank you. Thank you.
I think it's appropriate now, Chris, for us to move on with the next item, which is to review the results. Is that right?
Yep. Floyd or Alex
Perform.
Floyd or Alex can go through the numbers briefly. Just a couple of related items. The total asset value of the fund as of around 10:30 this morning was approximately 680.456 million. And that's after we've paid our share of the August benefits. I also wanted to mention that we have received, and I may have mentioned this in a prior email, but just for the record, we have received all the RFP responses for the possible replacement for Pine Bridge. There was north of 30 responses. They came in early to mid-July. Alex, Floyd, PFM, and myself are going through those. You imagine it's a lengthy process with that many responses, and we hope to have a short list of candidates for your consideration by the end of the year. And with that, Alex or Floyd, if you want to make any comments on the performance for July, which was positive.
Yes, and just briefly, Chris, we'll probably have our short list of names to you for large cap, but maybe by the end of next week or mid next week. So we can go through those. You can see the total fund. It was positive for the month of July, 0.86% relative to the benchmark, 0.82. On year-to-date basis.
Excuse me, I'm sorry. Could you, this is the court reporter. Could you repeat the numbers?
0.86% for the total funds. It's 0.82 for the benchmark for the month of July. On a year-to-date basis, the total fund is up 11.02%. Well ahead of the benchmark, which is up 8.78%. Largely on overweight to equities, although for the month of July, you'll see there was some good performances from some of the active managers.
I didn't hear that. For the month of July, there was
some good performance from some of the actives. Copeland, for example, within small cap, was down 0.4%. Its benchmark was down 3.6%. Also within small cap, the S&P 600 index outperformed the Russell 2000. So that's a little more normal and expected. Last year, the Russell 2000 outperformed the higher quality S&P 600. International equity saw good performance from the actives as well. Acadian was down 0.1. Its benchmark was down 1.65. And Ernest was just slightly positive 0.08. Its benchmark was also down 1.65. Within fixed income, you know, a mixed bag of performance. The actives, Weaver Barksdale was just below the benchmark. MetLife Core was right on top of the benchmark. Then, the investment like credit, slightly ahead of the Barclays aggregate. And really the detraction in fixed income came from Sky Harbor, which was only up 0.33%, lagging the core bond market. On a year-to-date basis, however, high yield is still pretty significantly outperforming core bonds. But again, we're looking at, ongoing, positive performance in U.S. equity markets, remaining challenges ahead for fixed income. We're not looking at an extended shutdown related to the coronavirus. We've seen vaccination rates continue to go up. So, again, there have been a little resurgence, but we're not looking at shutdowns like we saw a year ago. So just take any questions about the performance or any of the funds.
Any concern about inflation?
No, Floyd, I don't know if you want to address that. I think it's ticked back down somewhat recently, but I think a lot of it is demand driven. We've still seen a lot of people wanting to get back out there and buy and shop and go eat. I know seafood prices are high, but I think we're looking at this as temporary. Floyd, what else do you want to add to that?
Don, on the inflation side, we're not that concerned. I mean, we are concerned in regards to how long is above average inflation going to be here, and then what is it going to finally settle down at. But if you were to say inflation such as late 70s, early 80s, no, we realize that a lot of this does come from supply constraints. You're still seeing it now, even with now China having to shut down ports because of the Delta virus. Also because of raw materials, those inputs going up and becoming a little bit more scarce over the short term, because why people have not been able to go into the mines, either bring up those raw materials or farm and produce those raw materials. You've had the shipping backlogs that are still there, and they're getting cleared up, but they're still going to be there, which are also playing a part to this whole inflation story. And then on side of that, you do have the labor aspect, which has pushed up prices because you had so many people drop out of the labor force. You got about 3 million on that side that have just dropped out, left, quote unquote, retired from the labor force. You still have a fair amount of people on the sidelines, but if you're looking at it for job openings versus number of people unemployed, you do have more job openings than unemployed individuals, which is positive, but there still is a mismatch because you have a lot of people that have moved along with people that have left certain industries. Last but not least, on the inflation front, on the part that probably should at least raise hairs with everybody in this room, is the fact that, if you're looking at it from a real estate aspect, real estate prices do not play a big part within the inflation. Within inflation in regards to the calculation, but if you're looking at it for the price of rent, right now everybody's been dealing with, of course, the moratorium, but once that ends, the eviction moratorium, then you will start seeing that play within the prices. Right now, the numbers we have been seeing is at least within rent inflation seeing it go up at least 10%. So that's something that would end up flowing into into the inflation calculation. But if you were to say it like as a whole, is inflation going to be higher than in the past? Yes. Is it going to be that the 70s, 80s range? No. Are some of those things that are going on inflation, can they be worked out over time? Yes, I think, Don, the biggest thing is also there's going to be the time frame aspect. Transitory doesn't give anybody a notion of it. Does that mean 12, 18, 24 months? But we are seeing at least, at least 12 to 18 months, some of these aspects will have to die down.
Thank you.
No problem.
Any other questions in terms of
Yeah,
our performance?
I've got one. Alex, could you talk a little bit about Garcia Hamilton? They look like just on the trailing returns, they've been kind of consistently below the benchmark there.
Yes. First of all, I think I mentioned, I thought you were Callan earlier, Nick. I apologize for that.
No worries. I didn't even hear that.
Garcia Hamilton, would say typically held less plus, investments than some of their peers. If you look at some of the other, core managers, I think MetLife certainly. Lazard.
Alex, you're cutting out a little bit there, Alex.
Okay. I was just mentioning that Garcia Hamilton is relatively less, spread allocations than some of its peers. If you remember, Lazard was similar in that regard. They're going from understanding. They may not keep pace with some of the core plus strategies. Beyond that, I'd have to look at the duration, of this fund relative to both its benchmark and then the aggregate. It is an intermediate fund. So again, off the top of my head, I'm trying to think how that may have impacted it over the past year. Aside from, again, just the specific, strength or lack of strength of its credits, but higher yield, for example. Again, I would say Garcia Hamilton has stronger credits, but generally lower yield than maybe its peers. I will confirm that. Unfortunately, we don't have the holdings in this report. It's only the monthly flash, but I'll get the quarterly holdings, and again, confirm that is still, the case. Again, sort of higher quality, but maybe sometimes lower expected yield in a market like this.
Okay, great. That would be perfect.
And Nick, I would just add they're obviously they're in the muni fund too. I actually I'm waiting to get a memo from the person who staff member who works most closely on fixed income specific to Garcia. And I'll be happy to summarize and share my thoughts and notes as well when I get that. Circulate those to the group this week or early next week. Hopefully this week, as soon as I go through the memo with him and then ask any follow-ups. So I'm happy to pass those notes along as well.
Great, thank you.
Is there any new business before we adjourn?
Just real quickly, Don, 30 seconds. Bill, I think, and Fran alluded to some changes to the State Sunshine Act and open meetings law that are going to take effect at the end of the month. I think it's August 29th. The commission largely follows most of the things that are going to change. One change will be that we're required within 24 hours of the meeting, of any meeting, to post the agenda for that meeting, both online and then at the if it's in a physical location, at the physical location, as well as at the principal place of business for the sinking fund. And then only things listed on the agenda, although there are some exceptions, but mainly things listed on the agenda are those that are allowed to be voted on. There was some training last week. There's going to be another session, I believe, this Wednesday. I'll be attending that one, as will Adam. And he will summarize or send out any key, salient points for the commission following that training. Again, I think we largely are in compliance in terms of the transcript, now the recording of the meetings, posting certain things on the web, but I just wanted to make folks aware that there were going to be some small changes coming, by the time the next meeting rolls around.
So is there anything that you have in writing concerning those changes that you might be able to share with me?
We have what do we have? Slides, Adam. I don't know if those can be circulated or if you're going to circulate something else or both later this week. But we can put something in writing for sure, Don. Adam, I'll defer to you. I'll defer to you on what's going to be circulated.
Yes. As Chris said, we'll be attending a training from other law department attorneys who specialize in this area this Wednesday. So following that meeting, I should be able to give you a little more guidance, and we can provide some written materials, just kind of explaining the changes and what updates we can expect.
Excellent. And we've got to figure out a way to get Alex hooked up so we can understand what he's saying. So I'm gonna put that in your hands, Christopher, to figure that one out.
Okay.
Okay.
Not a problem. We'll have it straightened out by the September meeting, Don.
All right. Is there a motion to adjourn?
I will make a motion to adjourn.
All right. All those in favor say aye.
Aye.
The meeting is adjourned. Thank you very much for participating. Have a good day.
Thanks, everyone. Have a good week.
Thanks, everyone.
Bye-bye.
Thank you.
Bye, everyone.